Something unusual happened in global markets this week. Stock indexes dipped, currencies shifted, governments reacted fast. And at the center of it all was a familiar name: Donald Trump. This is Novus Narrator context beyond the headlines. Once again, tariffs, a single policy word, sent shockwaves through the global economy. But this story isn't just about taxes on imports. It's about leverage, power, and a changing global order. So today, let's slow this down. Let's unpack what these tariffs actually are, why they were announced, why markets reacted so sharply, and what this could mean for the world going forward. The announcement itself was simple, at least on the surface. The US signaled new tariffs on goods from key European countries, higher import taxes, stronger trade pressure, and the possibility of escalation if demands weren't met. Markets reacted almost immediately. European stocks slid. The euro weakened. Investors moved towards safer assets. And suddenly, a trade policy announcement became a global headline. Now, if you've been following politics for a while, this may feel familiar, because Trump has always treated tariffs differently from most modern leaders. To him, tariffs aren't just economic tools. They're negotiating weapons. To understand why this caused such a reaction, you have to understand Trump's worldview. Trump sees international trade as a scoreboard. If one country exports more than it imports, he sees that as winning. If the US imports more than it exports, he sees that as losing. And tariffs, in his mind, are a way to rebalance that score. But there's something deeper here. Trump doesn't just use tariffs to protect domestic industries. He uses them as pressure points. Pressure on allies. Pressure on rivals. Pressure on negotiations that have nothing to do with trade itself. In this case, the tariffs weren't just about economics. They were about influence. Think of tariffs like this. They're not a hammer. They're a lever. By threatening higher costs, Trump forces other governments to respond, publicly, politically, and financially. And markets know this. That's why they react before anything even takes effect. Because markets don't wait for policies to become law. They price in risk. So why did the global market react so strongly? After all, tariffs aren't new. The answer lies in uncertainty. Markets hate uncertainty more than almost anything else. When tariffs are announced, investors start asking questions. Will this escalate? Will Europe retaliate? Will supply chains be disrupted? Will inflation rise again? And the moment those questions don't have clear answers, volatility follows. European economies are deeply interconnected with the US cars. Machinery, technology components, luxury goods. Even a modest tariff increase can ripple through multiple industries at once. And that's before retaliation even begins. Currency markets reacted quickly too. When trade tensions rise, investors tend to move money into what they perceive as safer assets. That often means the US dollar strengthens, while other currencies weaken, which creates another layer of tension. Because a weaker currency can help exports, but it also raises import costs, which can drive inflation. And inflation is the one thing central banks are still desperately trying to control. So suddenly, a tariff announcement becomes a monetary problem. From Europe's perspective, this puts leaders in a very tight spot. If they respond aggressively by imposing their own tariffs, they risk a full-scale trade war. If they don't respond, they look weak domestically. And if they negotiate, they may have to make concessions they don't want to make. That's the trap. Tariffs force decisions. And this comes at a particularly fragile moment. European economies are already under pressure from energy costs, slow growth, and political fragmentation. A trade fight with the United States is the last thing they need. Yet doing nothing may not be an option. This is why markets reacted not just to the tariffs, but to the tone. The tone suggested escalation was on the table. And escalation is what markets fear most. Because once trade disputes start escalating, they rarely stay contained. What's important to understand is that this isn't just a US-Europe story. Global supply chains don't follow borders. If European manufacturers face higher costs exporting to the US, they may cut orders from Asia. If US companies face higher import costs, they may raise prices globally. If prices rise, central banks delay interest rate cuts. If interest rates stay high, growth slows. All of this from a single policy announcement. This is why economists often describe the global economy as tightly coupled. Pull one lever, everything moves. So the big question everyone is asking is this the start of another trade war? The honest answer is, not necessarily. But it could become one. Trade wars don't usually begin with massive confrontations. They begin with signaling. Tariffs are signals. They say, we're willing to escalate. What happens next depends entirely on responses. Will Europe retaliate? Will negotiations begin behind closed doors? Will exemptions be granted later? Markets are waiting for those answers. There's also a political dimension here. Trump's base tends to support aggressive trade policies. They see tariffs as protecting domestic workers and industries. So politically, tariffs are not a liability for him. In fact, they're often an asset, which makes markets even more nervous. Because political incentives don't always align with economic stability. This story fits into a larger pattern. The world is moving away from cooperative globalization and towards strategic economic competition. Trade is no longer just about efficiency. It's about security, resilience, influence. Tariffs are part of that shift. They signal a world where economic relationships are increasingly transactional. And that's why institutions like the World Economic Forum are buzzing right now. Because leaders are quietly acknowledging something important. The old rules don't fully apply anymore. In the short term, expect volatility. Markets will react to every headline, every statement, every hint of escalation or compromise. In the medium term, watch diplomacy. If negotiations open quietly, markets may stabilize. If rhetoric hardens, expect further shocks. In the long term, this could accelerate a trend that's already underway, the fragmentation of global trade into blocks. And for everyday people, tariffs rarely feel abstract. They show up as higher prices, slower growth, and uncertainty about jobs. That's why markets care so much. Because behind every index chart are real economic consequences. So yes, this story is about tariffs, but it's also about power, leverage, and the future of the global economy. One announcement reminded the world how interconnected and fragile modern markets really are. And as always, the most important part of the story isn't what was said, it's what happens next. This is Novus Narrator, context beyond the headlines.